Hi, I'm Steve Dudash, IHT Wealth Management. Welcome to this week's Wealthcast. All right, I want to talk about something a little different, and we touched on this maybe 12 months ago, but it's worth rehashing. Target date, in your 401ks, you have these target date mutual funds, target date ETFs, whatever you want to call them, investment positions in your 401k. All of you have it. Everyone who has a 401k, virtually all of you that have a 401k, have some lines in there of options that says like target date 2030, target date 2040, target date 2044, whatever. What those are, and more importantly, why those aren't they're not really the best thing for most people. They're good for a certain type of person. I'm going to explain that in a second. But for a lot of people, you got to watch out for those things. First and foremost, what they are. You put your money in there, and it's kind of like a cheater fund. It's nice in the sense you put money in there, and then every year as you get older, it gets a little bit more conservative. So in theory, when you retire, it's very, very safe, and you don't have to worry about wild fluctuations, and you don't have to worry about changing your allocation year in and year out. And that's where it's really nice. If you got someone who's young, who's just looking for something to put in there, doesn't really understand a whole lot about what different investment options are in there, and wants something that's kind of foolproof, wonderful investment. Put money in there and forget about it. 20 years from now, it's going to make a bunch of money. You'll be a happy person. But where it gets overused, and this is where you got to be careful, as people start hitting their 50s and their 60s, they start getting closer, 70s, get closer to retirement age. Those target funds are designed to be ultra conservative, whatever that target date is. So they start off, like today, if I did one, I'd say 50 fund, so it's 30 years from now. Today, it would be really aggressive. It would be all stocks. Every year, get a little more conservative, and then in 20, 60, or whatever the years down the road, 40 down the road, it is almost all bonds, all cash equivalents, very, very safe. The problem with that is when you retire, you're not done. Most people are retiring in their 60s and living into their 80s or 90s. That's another 30-year window. If you take all of your money, if you need growth, and take all of your money and put in something that stops growing in your 60s, you better be sure you got enough money in there to make you through your 90s, okay? Because statistically, 1 out of 2 people are going to make it to their 90s. So why I'm saying all this, if you don't need growth, if you have more money than you could possibly need and income doesn't worry you in your later stages of your life, then put in the target fund, be fine. But if you're like most people who need that money to continue to grow, when you're in 20s and 30s, fine, go for it, do it, no big deal. But when you hit your 40s, maybe you don't want it. 50s, start to really look at it. 60s, most people put these target date funds for when they're 65 years old, just because that's what the government implies in your head is when you're supposed to retire. Watch out, because most people need those funds to continue to last and grow over the last 25 of the years of their life, just like they needed in the first 25 years of their working career. Be careful. Call me, email me, whatever, whenever you get time, however is the best way for you to reach me if you have any questions. Have a nice weekend, and we'll talk next week. Bye.